Well, here we are on February 7th, first Friday of this month. Payrolls data just came out. I'll go over that briefly. But first, I want to start, just looking at the last week or so. Markets on crack again. Nothing can stop these markets. First, we had the Iran showdown, which could have accelerated badly. Now, I did strongly suggest at the time that given that Iraq, after that assassination, had decided to formally kick the U.S. out of Iraq, that was a huge win for Iran. And I really thought that they would just sit back, take that win, and lob a softball, which they did. Big missiles that hit nothing, so no accident. But now this virus, now that is really something that's hard to control politically, and certainly printing money will help the economy but won't stop the virus. And I mean, this is still unknown. It accelerated over last weekend dramatically, and the Chinese market, after being a holiday, opened down 9%. Now it's only down about 6 or 7. It's bounced some. U.S. had their big down day on the Friday before that weekend, down 600 points on the Dow, and it's been up to new highs ever since. Now, this has not been resolved. Yes, there's been no more bad news since the weekend, but there's no signs this is abating, and everything says it should accelerate. It's a question of how much it can be contained. It's already larger than the SARS virus. But the point again is, as long as the Fed's printing money and globally they're printing money, these markets are going to go up unless something really bad happens. And again, the virus still could accelerate. Now, what we've been looking at the last few weeks is tracking directly how the repo crisis. Remember, back in early September, Fed had to suddenly inject $60 billion because the repo rates had gone from 1.6% to 10% overnight, saying banks weren't lending to each other, so the Fed had to step in. Well, they kept stepping in. And repos got, let me give it here, to a peak on January 1st, 256 billion injected by the Fed, okay? Now, but they also did old-fashioned QE, buying T-bills, injecting money into the financial markets to increase bank reserves so this repo thing would tail off, which it has. And now here we are in early February, the repos have dropped to 170 billion. That's about 85 billion drop. Okay, so that doesn't mean, that means not only is the Fed not buying more repos to keep the crisis down, the repos are dropping off. So their balance sheet is going down there. But at the same time, the T-bills were about 170 billion in January 1st, and they've gone up to 248 billion. So you've had about an 85 billion drop in the repos and an 82 billion rise in T-bonds, T-bills. Now this is important because the real question mark now is the repo market. It is subsiding for now. Does it come back? What the Fed pledged to do weeks ago, and I warned our subscribers of this, they came out and said, our plan going forward for now is to continue buying T-bills, and they mentioned T-bonds. They were projecting 60 billion T-bills a month and 20 billion T-bonds. That is, again, 80 billion a month versus 60 billion at the peak of QE. So this is QE more than ever, and the balance sheet's going back. It's only 300 billion or so from its all-time highs back in between late 2014 and late 2017. So we're heading towards a higher balance sheet and printing faster than ever. And yes, stocks, we've been measuring on about a 2.5 to 3 week lag. Since that September injection, stocks have been going straight up with this, and they've been going sideways, if you noticed, in the last 3 or 4 weeks. Well, that's exactly in line with that 2.5, 3 week lag and kind of the peak. Now, this indicator says that stocks, even though they've gone to new highs here, will probably have a harder time climbing. Futures are down this morning, even though a surprise, 225,000 rise in payroll jobs, non-farm payroll jobs versus 158,000 expected. That was good news, but despite that, the futures are down 130, 140 for the Dow, which says we may have seen a temporary peak in this second slight new highs in the markets back on Thursday and Friday by different markets. So this indicator suggests, our stock indicator with the Fed balance sheet, now that it's stalled, that yes, we should go sideways to down. This correction is probably going to see another 3, 4, 5% down into late February. And if we can hold there, and if they keep buying these T-bonds and T-bills, especially the T-bills, and the repos don't decline further, or if they start to come up again, then we're going to see strong stimulus behind stocks. So again, the repos are the $1 million, billion, trillion dollar question right now. If they keep declining against these purchases of T-bills and bonds, then stocks are going to be neutral. If they continue to buy these T-bills and bonds, which clearly seems to be the case, last 2 weeks, it's been $37.5 billion, which on a monthly adjusted basis, a little over 4 weeks a month, it's right on that $80 billion target that the Fed's been saying. If they keep the $80 billion a month and the repos go up or flat, then we're going to have plenty of stimulus to keep driving this market up in the months ahead until the Fed pulls back or we get a bigger crisis or the virus blows up. So again, we're going to keep you updated on that. That's where we're at on this right now. Repos are the big question. The Fed is clear otherwise, and don't buy this argument on Wall Street. Oh, this isn't quantitative easing. The repos or the T-bills, or if they start expanding the bonds, is all the same at the fundamentals. When you inject more money created out of thin air into the financial asset arena, because you're buying financial assets from holders of financial assets with new money. It's not like other people they buy from who have to sell something to sell to them. No, this is new money coming in, and that new money will push all financial assets up. And again, Fed says, oh, we're just buying T-bills. That means we're not intentionally pushing long-term rates down. Yeah, but if you're buying T-bills from people, it means they feel like they have enough cash. So what are they going to do with that cash they get from the Fed? They're going to buy higher yield bonds, junk bonds, or stocks. So don't fool yourself. And our indicator, clear correlation. Fed pumps in more money, repos, T-bills, anything. And it's gone up now $418 billion in the last 4 months or so. And it looks like it's getting ready to head up again, but we'll wait and see. And we've got that nice 2.5, 3 week lag to give you some advance notice when things look like they're going to be, correct or step back or keep going up. And they look like they're going to continue to correct a bit for the next 2 weeks or so. So again, we'll keep you updated.